It is Friday, October 23rd, 2020. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was yet another Get Your Ass Kicked at Jiu-Jitsu Friday, although I did not stay for my round today. I was feeling a little bloated and a little not fresh and ready for that kind of thing today. I don't know. It was just one of those things. It was like, I feel like I got a bowling ball in my gut at the moment, so I don't want a chance that somebody's going to squeeze it out of me when I'm in a body triangle or something like that. But anyway, it was good to get in, and definitely got in some good training today. We did some stuff from the closed guard, and it was transitioning to rubber guard, and I'm trying to remember all of it, because like the first part of it we did was just the omoplata, and then we did a armbar transition from there. I think it was a weird kind of armbar where if you got your legs stuffed, to stuff their arm and then kind of fold in the elbow towards their gut, and then bring your knee up on the other side of their shoulder and press into it. And from there, you got their arm kind of limp across your upper body. But if you've got their elbow down just right, you can grab them by the wrist with both hands and execute a nice little armbar from there. It's really, really tight armbar. And so I felt like I got that. It's something I'm going to definitely need to spend a good deal of time working on. I mean, just the getting up on the side part was kind of weird for me. And we tried it with just a little bit of resistance and tried going just a little bit faster. And I found I was having a lot of trouble grabbing onto the meat hook. And that's really important if you're not able to get your feet clasped around your opponent. Although I did find that the one thing that the instructor told us, and I neglected to do it, and I think it's really the one thing that would have made the difference, was that, and I did it on a couple of times, but I grabbed the crown of my opponent's head and pulled down, and I think that was a real key part of the movement that I hadn't been doing, or that I'd only done on one or two of them. But yeah, like I said, it was good to get in. I liked the arm bar that we were working on, because I felt like when I got my knee in there just right, it was a really, really tight arm bar. Although I felt just as good going for the other side arm bar, but I don't know, I get more out of chokes. I like choking people. I guess I wonder what that says about me, that I prefer a choke to an armbar. I mean, mostly I think about damage to my opponent. I think there's some things that they're really, really uncomfortable. They're not necessarily going to like break somebody's arm or whatever, but if you twist somebody's arm in like a Kimura or an Americana, you might not break it, but you can make it not really hurt. I mean, not really feel all that good. Make it to where they want to change the body position. They need to change the body position. Just not very comfortable in the way they are right now. But yeah, so we worked from the closed guard to the rubber guard to an omoplata. And the omoplata is one that I keep screwing up on, because you got to put your arm out and then bring your body over just a little bit before you're able to set your hips right on your opponent. And I don't know if it's because they haven't really been concentrating on enunciating and mentioning that, or just the fact that I haven't spent enough time doing omoplatas. But for some reason, I keep neglecting that one little aspect. And it does make a really big difference in the angle that your opponent's at if you're able to ground their shoulder and then kind of roll over on top of them a little bit. But you don't want to lean back too far because, of course, they can get their arm out. Anyway, I know that's kind of brief and whatnot, but I really want to get in there and take a shower. So let's go ahead and throw down with some music. And we're going to start with Body Count. But again, the question is the song. I actually did go through and organize my tabs and stuff to where we got some sort of a show set up for you today. I mean, I know that's a rarity. Don't pass out. But I did a little planning. And so anyway, as far as where to go, what we're going to do for our first dance, I'm thinking the ski mask way. So here it is. Body Count, the ski mask way, first dance, here on Coin Metal. And that was Clutch with a Shogun named Marcus. And so, as far as what we're getting into today, like I said, I did some sorting. I actually did some organization, and I actually have all of my tabs set up in pretty much the order that I want to get to them. If we actually get to all of them, we may not. Anyway, first thing I got here is on SoMag News. SoMag News. I don't know what that means, but I'm sure it means something to somebody. Bloomberg analyst, government may ban Bitcoin. And this is by Daniel Kuchar, and it was authored on October 23rd, 2020. So yes, penis. A big warning about Bitcoin came from Bloomberg analyst Mike McGlone. According to McGlone, Bitcoin can be banned by the state. Famous Bloomberg analyst Mike McGlone commented on Bitcoin in an interview with David Lin of Kitco. McGlone stated that he does not ignore the risk of Bitcoin becoming a failed cryptocurrency. For this reason, Bitcoin is also a risky asset from gold for the analyst. McGlone said Bitcoin is a new technology and has the potential to always fail. He stated the following on the subject, quote, "We know that Bitcoin is a new technology. It may fail. I don't know what can be said when technology and regulations are considered. It can be banned or tried to be taken under control." Analysts said $100,000 could be for Bitcoin. Lynn asked Mike McGlone's prediction that Bitcoin will be $100,000 by 2025. McGlone commented on the Bitcoin price, quote, "The most important thing Bitcoin has done since climbing first to $100 and then to $1,000 and then finally to $10,000, which really has been the consolidation price for the last 3 years, has been just adding the zero at the end of the price." Drawing attention to the correlation between Bitcoin and gold this year, McGlone said that Bitcoin is digital gold and added, quote, "Bitcoin is following gold. Gold has just made highs, but the macroeconomic development is pretty important in my opinion. Factors like unprecedented GDP rates, quantitative easing, negative rates make assets like gold and Bitcoin attractive. Tether will come after Bitcoin." According to the news reported by U.Today, among the questions asked by Lynn to the analyst are CBDCs and other cryptocurrencies. McGlone said he first believes that digital central bank coins will cause Bitcoin to become more in demand, and that Bitcoin is the gold of CBDCs. However, he finally expressed once again that he was confident that Tether would take the throne of Ethereum, and that he believed Tether would come after Bitcoin. This guy's a fucking moron. Hey, dipshit. Sorry, I hate calling anybody a name, but like seriously, you don't know what you're talking about. You think that Tether will take the throne of Ethereum? Tether works because of Ethereum. Yeah. Tether exists because of Ethereum, exists because of Bitcoin, exists because of Tron. It doesn't exist on its own. It's not a cryptocurrency unto itself. It's a token. And if the SEC were actually serious about their business, they would be all up in iFinex's ass saying, hey, yo, we're going to bust you for these unlicensed securities that you're circulating to the tune of some $15 billion in the world economy. Fucking sickness. It's absolute sickness. You know, and it just shows you the true function of regulation. It's like if at this point Tether were only worth, say, like $4 billion or maybe even $400 million, the SEC would be all over them. They'd be like, "Hey, what are you doing there? You're circulating unlicensed securities. You got to stop that." See, I believe that Tether in particular is actually a proxy of the Federal Reserve or the U.S. Treasury, one or the other. And the reason I say that is because they are if you were to consider all the cryptocurrencies out there and were to ask yourselves, which one of these, you know, which whether it be a regular mined cryptocurrency or whether it be some sort of masternode cryptocurrency or a proof of stake cryptocurrency or even an ICO or a DeFi project. If you were to take all of these things and compare them to stable coins, out of all of them, which would you say most closely fits with the description of something that is a security according to the Securities and Exchange Act? Having read parts of it here on this show, I can tell you that in my mind at least, stable coins, Tether, Gemini Coin, what's that other one? There's a few of them out there. DAI. I don't know about DAI other than the fact that they do have an issuer. So, yeah, DAI too. But there's another one out there that it's like Circles Coin or USDC. That's it. So, if you were to take the description of what a security is and you were to compare them to ICOs, the one that sticks out the most is stable coins, because they have an issuer. They have an issuer, and not only that, the issuer is the only entity out there that can 100% verify both the collateral and the tokens that are representing that collateral in the marketplace. So, they in terms of Tether, iFinex runs Tether, okay, and tethers are issued by them. They are the only ones that know for certain whether or not they have collateral matching the volume of Tether in circulation. I mean, there's transactions on the Bitcoin blockchain. There's transactions on the Ethereum blockchain, the Tron blockchain, the fucking Omni blockchain. They're all over the place. They're all over the place. But the question has always been whether or not they actually have cash reserves that are backing those USDTs circulating in the market. And the assertion is no, they do not. That they are completely insolvent. They don't actually have any functional banking. And, everybody's just ignoring them, though, because I think, anyway, the only reason they're really being ignored is because behind them is the Federal Reserve or a other central bank. And that's the only reason they're not being touched. Because, like I said, otherwise the NYDFS would be up their ass even harder than they actually are. The U.S. Treasury would be up their ass. All these entities would be after them, but they're not. And so, like I said, it leads me to believe they're a little shady. Anyway, the next one I got up here is on CoinDesk.com. Blockchain bites. China's Tether crackdown. CME's bustling Bitcoin markets. Kin's active development. And this is authored on October 23rd, 2020 at 16:16 UTC. And this is by Daniel Kuhn. So yes, penis. And Daniel, I'm going to tell you right now, if you did bullet points, I'm not going to be really happy with you. Chinese officials are cracking down on Tether trades. The CME Bitcoin Futures Exchange is heating up, signaling institutional interest, and Kik's Kin token will continue development following a $5 million SEC settlement. Top shelf. Ripple across the pond. Ripple CEO Brad Garlinghouse has given more insight on the company's possible move away from the U.S., saying the legal status of the XRP cryptocurrency is key. Talking to CNBC Friday, Garlinghouse said his blockchain payments infrastructure company could potentially relocate to London, where the nation's regulator clarified that XRP is not a security and is used like currency. Ripple is currently engaged in a U.S. legal dispute with investors who claim XRP is an illegally issued security. The Securities and Exchange Commission has not been clear on the issue. Actually, they really don't have a place saying a goddamn thing, and the investors need to suck it up. If you're not getting the value out of your investment that you put into your investment, that is your fault. It's not the SEC to say this is a security and this is a cryptocurrency, this isn't a cryptocurrency, and it's not their place. They're the wrong entity to pay any attention or mind. Anyway, continuing. The Securities and Exchange Commission has not been clear on the issue. Switzerland, Singapore, Japan, and the United Arab Emirates are also on the table for potential headquarters. Actually, they'll probably go to Zug in Switzerland. Tether crackdown. Chinese authorities, including the nation's central bank, have arrested 77 suspects and shuttered 3 gambling sites said to have whitewashed illicit funds using Tether stablecoin. Announced over WeChat, the PBOC's Huzhou office said the suspects had laundered 120 million yuan, $17.95 million US dollars, obtained through illegal online gambling activity, in part through USDT. In July, several crypto over-the-counter traders were detained in order to assist with state investigation efforts involving illegal economic activity. It is, quote, illegal to open casinos and participate in gambling online, the PBOC said. Don't be curious and lucky. Any disguise can't escape high-pressure supervision. That's not entirely true. It's one of the reasons why they bother saying something like that is because they can't actually do anything about it. Institutional interest. The Chicago Mercantile Exchange, CME, has become the second biggest Bitcoin futures platform by number of open contracts, signaling institutional interest. As of Thursday, Bitcoin futures contracts worth $790 million were open on the CME, according to data source Skew, topping 15% of the total global open interest. Quote, the CME's rise is predominantly led by institutional participation, as most entrants from that segment are prohibited from dealing in unregulated derivatives listed on retail platforms such as BitMEX and Binance, said Matthew Dibb, co-founder of Stack Funds. This happens as rival options exchange BitMEX targets DeFi-focused futures listings, including Yearn.finance. Whooping by. Grayscale Investments has added $300 million worth of cryptocurrencies to its balance sheet in a single day, CEO Barry Silbert tweeted late Thursday evening. The additional sum brings the total held under management to $7.3 billion. Quote, the move comes at a time when the hype surrounding PayPal's foray into the crypto markets has drawn additional attention from big-name investors, including Paul Tudor Jones II, CoinDesk's Sebastian Sinclair reports, and follows on the digital asset manager's best quarterly results to date, announced last week. Grayscale is CoinDesk's sister firm, both owned by Digital Currency Group, of which Silbert is a founder. Good little disclosure there. Kicking back, Kick's $5 million Security and Exchange Commission settlement won't kill Kin, the nonprofit behind the token announcement. The cloud of uncertainty has dissipated, the Kin Foundation claimed in a blog post. With Kick's remaining treasury and Kin's reserves, project leaders intend to, quote, continue active development of the open source Kin SDK, the new code wallet, and a switch to the Solana blockchain. The foundation also alleged the SEC isn't considering Kin a security, and the judge didn't find the token in violation of securities laws. Therefore, Kin should be free to trade on exchanges. Most influential 2020, cast your vote. 2020 has not been a good year by most metrics. There is no way to avoid this in a year-end retrospective. Every year, CoinDesk recognizes the most influential people working to expand cryptocurrency and blockchain's reach. It's a list of the 10 outsized individuals who have gone the furthest and done the most. In this most unusual year, we need your help determining who should be named the most influential. Check out the list of the top contenders and cast your vote by October 31st. I'm pretty sure I'm nowhere on that, but, hey. I'm not doing this for that kind of recognition. But yeah, so it sounds like a bit of silliness, I think. There's been a lot of use of Tether in quote-unquote money laundering. And that's just what I gather from rumors, a lot of innuendo out there, specifically in Eastern Bloc countries, that former Soviet states have been using Tether to quote unquote, or not the states themselves, but entities within those states. But the funny part is that we're starting to see these pools of black money, or dark pools of money, or whatever, however you really want to phrase it. But we've seen these dark liquidity pools that have been funding all kinds of bad shit out there. And, there's supposedly this big clamor by the DOJ and whatnot to watch out for transactions that are, suspicious in nature and might be funding terrorism or some shit like that. But, it's like they're really, really selective, it seems, in how they apply the powers that they have. And this is one of the reasons why I've always felt that they should kind of be disregarded when it comes to cryptocurrencies, just because so little actual crime happens concerning cryptocurrencies versus fiat currencies. That's just the way it is. And so expecting that that's going to change, I don't. But we have been seeing where some things have been getting busted, and it's like that. I've always felt that that's one of the reasons why regulation is always going to be fuzzy with regard to cryptocurrencies, because there's no way that regulators could prosecute everybody the same. That they would end up coming across having to prosecute their own children or their own relatives or their neighbors. That pretty much anybody could be involved in cryptocurrencies, and that some of their own funding might in fact be coming from cryptocurrencies. And as it is one of the fastest growing segments or industries in our economy, I would go so far as to suggest it's almost impossible to have made a significant amount of money over the last couple of years without being somehow involved in cryptocurrency investment. But that's just my opinion. I think that over the longer term, though, we are going to see some sort of intervention with regard to cryptocurrency, and mostly we're going to be seeing it in the places where it interfaces with fiat currency. And that's really the place that they should be concentrating, because it's within their purview to manage fiat currency. But the answer for us and those that are involved in cryptocurrency is to be trying to create economy around them that is willing to transact in cryptocurrencies. So, maybe somebody who raises chickens and grows eggs, grows them for eggs and sells the eggs. If you can get that person to take cryptocurrency instead of physical notes, say, hey, let's do this transaction in Verge. That way you're establishing a monetary base outside of the fiat system entirely, and there isn't anything that anybody can do about it. There isn't any regulation that documents that the egg came into an existence. There isn't any way other than the transaction on a blockchain, not necessarily indicating what the transaction was for, who was involved, when exactly it happened. All of these things can be obscured. And so the reality is that you could be conducting these transactions for pretty much anything. And then it just becomes a matter of what people want and your ability to fulfill on it. And I think ultimately that's how this economy is going to evolve. And not just cryptocurrencies, pretty much everything. And people talk about there being some sort of drift to one specific cryptocurrency, such as Bitcoin or Ethereum. They're just talking out their ass. They don't pay attention to people. Different groups of people value different things, have different currencies that mean more to them. And these are markets. And in this new age, we're able to granulize it down to interest pools, where people that don't want to deal with people that want to support war and other endeavors that they consider to be malinvestment, where they could be transacting their monetary value in those systems or their own systems, and simply avoid funding the things that are going on that they ideologically opposed to, or are opposed to, rather. And that's really, it feels like an odd thing to say, and I know I say it a lot on this show, but it feels like an odd thing to say, because that kind of concern or that kind of power has not been in the hands of average people for a very, very long time. You know, for I would like to say probably the last century or so, we've had money that the relative value of the money is more or less dictated to us, as opposed to having any kind of relation to an intrinsic value somewhere in the mind or in physical reality. It just doesn't exist. You know, there's no symmetry between the amount of gold there is in circulation, the relative value of the gold, and a valuating metric where you could take the gold and the dollars and say at any time, you know, this head of lettuce is, you know, 0.03 grams of gold and it's, you know, 30 cents. You know, there isn't any real relation when you disseminate what a dollar is in terms of the weight value of gold or weight value of silver, as the case may be, and the actual amount of gold out there. I mean, if we were to go by that kind of standard, you know, it'd be like $250,000 a fucking ounce. And so then, you know, that would, again, would alter how much you were entitled for that slice of bread or that egg, or, you know, whatever it may be, whatever the commodity may be that you're wanting to utilize gold, dollars, Bitcoin to purchase. You know, and like I said, so this hasn't been in the concern of the average person for a very long time. And we are going to go through some periods where we make mistakes, you know, where some coins are overvalued, you know, that their dispersal rate or their availability or whatever is off, and somebody is making a disproportionately high value, or high profit rather, off of the creation of the token or the mining of the token, or whatever the case may be. That's going to happen. You know, those people got lucky. Those people timed the market properly. Those people manipulated things in a certain way. They didn't necessarily rip people off, but they were ahead of the game a little bit. And of course, that's really the point where we're going to see the most trouble adapting. You know, because value is in the mind of the bag holder. It's not in the open market. The open market is fickle and isn't really rational about the decision it makes all the time. So, you know, I guess the greatest change, though, that it's going to mean for us is getting over this illusion that it is at any time been any different. You know, you face the same risks today as anybody has ever faced when they step outside their door. As a matter of fact, when they get out of bed, you face the same number of risks. Maybe the nature of the risks have changed just a little bit, but the risk still exists, and it might not kill you all at once, but it's never stopped trying to kill you or rob you or whatever. You know, it's just your level of immediacy or intensity of experience may have gone down a little bit, but like I said, the volume of it is still available. It's still there. And when we get over the illusion that it disappears or it goes away, we'll start looking at things in terms of what it's really worth to us. You know, if I got a miner mining away all day, I'm going to be putting a premium on the coins that I sell from that mining. I'm going to be saying to the market, you know what, this is what it's worth to me. I don't give a fuck what y'all are selling your Bitcoin for. I'm going to put my sell price on the book at this, and you're either going to meet it or you're going to go fuck yourself. You know, and that's really the level of power that we have. And when more people start exercising it, we're going to see some real change happening out on the market there. Anyway, let's go ahead and throw back down with some music. But where to go? got some prong playing in the background, and actually I really, really like this song. So let's go ahead and play it. Get a grip on yourself. Prong, here on Coin Metal. And that was Judas Priest with You Got Another Thing Coming. And so, moving along, let's see, we tapped on China's blockchain, blah, blah, blah. The next one I got here is on CoinDesk, of course. DOJ's crypto framework is, quote, a complete disaster for digital privacy rights. And this is authored on October 22nd, 2020 at 1400 UTC. And this is by Nicholas D. So yes, penis. The U.S. Department of Justice recent crypto enforcement framework is a threat to digital privacy rights, according to an attorney for the Electronic Frontier Foundation. Quote, it was a complete disaster for privacy and anonymity and civil liberties in the cryptocurrency space, said Marta Belcher, special counsel to the digital rights advocacy group. The framework, released earlier this month, details the U.S. government's approach to crimes committed using cryptocurrencies, but also appears to define some broad policy positions on crypto and crypto exchanges more generally. Belcher, who is an attorney with Ropes and Gray, and an outside counsel to Protocol Labs, said the framework, released earlier this month, raises many concerns about privacy rights, pointing to language on peer-to-peer exchanges, mixers, tumblers, and anonymity-enhanced cryptocurrency privacy coins. Interesting. Let me see if we can find where the person actually said this, because that sounds like it was a much bigger article. Or at least I feel like it probably should be. Yeah, here we go. And we probably covered this one already at some point. The DOJ's crypto enforcement framework argues against privacy tools and international regulation. And for international regulation. Yeah, go fuck yourself. This was authored on October 8th, 2020. So not really all that long ago, this month. At 14 UTC. And this again was by Nicholas D. U.S. Attorney William Barr's Department of Justice believes cryptocurrencies pose an emerging challenge to law enforcement activities, according to a new publication filed Thursday. The DOJ's Cryptocurrency and Enforcement Framework document published by the Attorney General's Cyber Digital Task Force outlines what cryptocurrencies are and their potential use cases, including sections on both legitimate and illicit uses. Though the legitimate uses section has been used to support terrorism, purchase illicit items, conduct blackmail and extortion, cryptojacking, and launder funds, according to the document. And the DOJ has spent the last 2 years determining how best to address these issues. Ignore them. Quote, these efforts are paying off, wrote Sujit Raman, the task force's chair, referencing recent cases against would-be token issuer Telegram, child exploitation ring Welcome to Video, sanctions designations, and other efforts. And while the report was published by the DOJ, it encompasses efforts by all parts of the federal government, including civil regulatory agencies. Yeah, but none of this shit is based on law. Yeah. In his statement, Attorney General William Barr said, quote, cryptocurrency is a technology that could fundamentally transform how human beings interact and how we organize society. Ensuring that use of this technology is safe and does not imperil our public safety or our national security is vitally important to America and its allies. Yeah, you know how you do that? You be better. So tax less, monitor less, give less a shit. And less money will come into cryptocurrencies, because that's really what people are trying to avoid with crypto, is dealing with you. Continuing. The report itself is split into 3 sections: an overview of the cryptocurrency space and its current illicit uses, the laws and regulatory agencies that oversee the space, the current challenges, and potential strategies to address them. The report warns that cryptocurrencies are more difficult for investigators to learn about than previous tools for executing crimes, citing pump and dump schemes as one example. Quote, "Cryptocurrency is a technology that could fundamentally transform how human beings interact and how we organize society, ensuring that use of this technology is safe." And we already read that quote. "Investigators must learn to use, quote, specialized communications applications," the report said. Further, the markets being used evolve rapidly, with the report pointing out how the initial coin offering boom has given way to decentralized finance markets. The fact that blockchains are borderless, allowing anyone from any part of the world to interact with the markets, adds a further layer of complexity. Yeah, it was never your fucking business, and now it's especially not your business. So fuck off. Continuing. Finally, decentralized platforms, peer-to-peer exchangers, and anonymity-enhanced cryptocurrencies that use non-public or private blockchains can further obscure financial transactions from legitimate scrutiny, the report said. In short, much of the first section of the report simply provides an overview of cryptocurrencies, blockchain, and distributed ledgers more broadly, and how they've been used over the past few years. The report distinguishes between virtual currencies, which are digital representation of value, and cryptocurrencies, which it describes as being in a subset of virtual currencies that are decentralized and based on blockchains. No, they're not based on blockchains, they're based on networks. Networks of miners. Continuing. It goes on to explain addresses, wallets, miners, and other aspects, noting that while some transactions are private and easy to query on the blockchain, some cryptocurrencies emphasize privacy. The DOJ does not appear to be a fan of these currencies. Too fucking bad. Quote, "As discussed in Part 1, a wide range of criminal activity may involve or be facilitated by the use of cryptocurrencies." And again, too fucking bad. On numerous occasions, the Department of Justice has used available legal tools to pursue successful prosecutions of such activity, the report said in the opening of its second section. It summarizes the U.S. government's actions over the past few years. In addition to criminal cases brought by the DOJ, civil cases brought by the Securities and Exchange Commission and Commodity Futures Trading Commission were highlighted, such as the SEC's case against Telegram, which raised $1.7 billion in an initial coin offering, but ultimately had to refund investors. Agencies with oversight or enforcement power in the space include Financial Crimes Enforcement Network, FinCEN, the Office of Foreign Assets Control, OFAC, the Office of the Comptroller of the Currency, OCC, the SEC, the CFTC, and the Internal Revenue Service, IRS, and the FATF, an intergovernmental organization that provides standards and recommendations for international money laundering rules, also received a mention. Enforcement. It is the third section, ongoing challenges and future strategies. However, the DOJ noted that some exchanges and entities play, quote, jurisdictional arbitrage, looking for the friendliest jurisdiction in which to operate. This can harm law enforcement agencies' efforts to, quote, investigate, prosecute, and prevent criminal activity that involves virtual assets, the report claimed. Quote, in the United States, AML-CFT standards have been in place for engaged money services or business or MSBs engaged in virtual asset activities since 2011, and yet many virtual asset service providers or VASPs are still operating in ways that do not comply with the Bank Secrecy Act or the BSA and other regulatory requirements. The report said it's because we're not dealing with fucking securities or your fucking banks or any of that other bullshit. We're dealing with cryptocurrencies that have public ledgers that the public is involved in mining, creating. And we trust in this. It's not really trust, but it is verifiable. Continuing on. Referring to anti-money laundering / combating the financing of terrorism standards, blah, blah, blah. This concern is exacerbated with companies that operate across different countries. A VASP may apply a different standard within the U.S. than it does outside it, or use different standards for crypto to fiat transactions compared to crypto transactions, the report claimed. Yeah, it's because one of those is your currency and one of them is not. And in terms of crypto to crypto, neither one is yours, so you can fuck off on both ends. Quote, such behaviors are flatly inconsistent with VASP's BSA obligations and can create significant financial intelligence gaps. Yeah, you know what? Too fucking bad. If you knew what you were looking for, you could be as specific as you want. But see, that's not what's being asked for, though. What's being asked for is some giant fishing expedition where you just collect everybody's data and you document everybody's data and you're documenting and scrutinizing everybody's data. And the problem is that that's not in their interest, because what will happen is they'll disseminate to you their customers' data, and then you'll do some sort of fucking enforcement action. And then they're going to go back, the customers are going to go back to the service provider and say, what the fuck? Why did you give them my information? And they'll say, hey, these guys waved a gun in our face. And then they will stop being the service provider that customer uses. Whether or not the customer themselves was involved in illegal activity, it's the fact that the advantages of using cryptocurrencies have been completely lost to them through that provider. And so now they're going to look for a darker, less transparent, probably more risky service provider to facilitate their need to get the fuck away from you. And that's your fault, because you really had no business in their shit to begin with. You know, it drives me nuts that, you know, these organizations, they write some shit down on a piece of paper, or they type some shit out on a digital sheet, and they just assume that, you're going to comply, man. You're going to fucking do what I tell. No. I'm not doing this shit to comply with you. I'm doing this shit to avoid having to deal with you entirely. And the thing is that it is going to be cheaper in the long run, and you're going to eventually do it anyway. It is cheaper for governments and banks and other financial organizations to simply contribute to these networks. You want to understand what's going on? Mine Bitcoin, mine Ethereum, mine Verge. You're going to do that anyway. You know, and I think that Bitcoin and other cryptocurrencies, they do something that I don't think anybody really saw it coming. I think I kind of saw it coming. I had like the first inklings of it, I want to say in like 2010, 2011, was that Bitcoin and other cryptocurrencies and the process of mining them, it does something really, really special when it comes to computing. Okay, because the incentive with Bitcoin is that you want to mine more Bitcoin than other people. You want more of the reward than other people get. Well, the way you do that is by contributing more hashing power to the network. Well, you can do that, but like you run into physical limitations. You run into limitations like the size of the facility you can affordably run before you start running into break-even points, where it's like, by the time you get your facility up and running, the miners that you bought to inhabit it the first time, they're already a generation behind by the time that you're all up and running. So you're going to have a lag period where you're not going to be making money. You're just going to be making investment capital so that you can buy your next set of miners. But there's limitations to it. And I also believe that because governments are going to... Anyway, I was going off on a tangent there with regard to limitations. And so, like, eventually you're going to want miners that are more efficient, that are smaller, that don't take as much to cool. You don't have to do big ass fans or anything like that. You just do semi-aquatic pools, and you're doing liquid cooling or some shit like that. The point being that this incentivizes higher efficiency in hardware. It makes it more profitable for hardware manufacturers to produce certain hardware because there's more demand for that hardware. And the better that hardware performs versus other hardware of the same class, the more business that vendor is going to be seeing. And so there's this constant competition now between these vendors to be better than their other competitors in this space. And that's really what's been done to fiat currencies, is they've been provided with competition. They're still scrambling about trying to figure out how to deal with it. And really the answer is invest in cryptocurrencies. Whether it be buying volumes of Bitcoin, buying volumes of Ethereum, and either holding them or facilitating them in your own projects. There's nothing that says the government can't do that. You know that? There isn't anything in open source software, there isn't anything on any law book that says the government cannot craft software for things like mining cryptocurrencies or hosting a wallet or any number of things. I mean, there is nothing that says that they can't. And because of the low amount of actual like investment per the profit and advantage and incentive you get out of it, it's completely inevitable that governments will somehow engage in this. But I think in the long run that we're going to understand that it is far more expensive to us just in loss of legitimate business and in investment in investigative groups and all that other shit. I mean, because those people need hardware, and of course they are going to charge you hourly for their services. All that shit costs money. And this always drives up the incentive to do crime. Because it costs you more money to monitor, it costs you more to enforce these regulatory measures. You have to bust somebody for more in order for it to be worth doing. So you're not going to be pursuing people that are circulating millions of dollars or even hundreds of thousands of dollars. No, you're going to have to go for billion-dollar people in order for it to be worth it to you. Well, I can create a lot of harm between $100,000 and $1 billion. A lot of economic harm. And so this is the rub. You have to consider all of the costs of regulation, and not just the ones that you're imagining you're going to be able to impose on other people. And so I got this thing here. It's on CoinDesk. Money Reimagined. They Starve. The Ugly Side of U.S. KYC/AML Obsession. And this is authored on October 23rd, 2020 at 15:31 UTC. It was authored by Michael J. Casey. And this is in the opinion section. But yes, penis. At a 2015 blockchain event, Nairobi-based Bitcoin pioneer Elizabeth Rosiello answered an audience question about the impact on Somalians of a recent shutdown in remittance inflows after the U.S. government had labeled the country, quote, a high-risk jurisdiction. The AZA Group CEO's answer was blunt, quote, they starve. Ever since then, I've come to see government's demands that banks use know-your-customer identification models to meet anti-money laundering goals as mostly counterproductive. Western governments thought they were starving East African terrorist groups like Al-Shabaab of funds, but the terrorists still mobilized money. Instead, the measures starved the local population of food, creating a ripe recruiting environment for the terrorists. Oh, what? Okay, yeah, this story is relevant because Sunday marks the 50th anniversary of the Bank Secrecy Act, or BSA, the landmark U.S. law that required banks to identify their customers and monitor their transactions. Over time, spurred by events such as September 11th attacks in 2001 and the 2008 financial crisis, the BSA rules have become stricter and wider. They've also spawned other rules for non-bank payment providers and given rise to powerful agencies such as the Financial Crimes Enforcement Network, FinCEN, and they provided the model for an international monitoring system that incorporates pretty much every financial institution in the world. Sadly, there's very little discussion of all this financial surveillance's impact on people's lives. Courtesy of Edward Snowden's revelations about the National Security Agency monitoring our online activity, people know about the NSA. They know little of the BSA. Exclusion. Perhaps people accept the trade-off between losing privacy and protecting society from evildoers. Still, the system carries enormous costs. It contributes to financial exclusion. According to a 2017 World Bank report, 1.7 billion adults are, quote, unbanked worldwide. For people in underdeveloped countries with untrusted state-run identity systems, the system makes them ineligible for bank accounts. It also contributes more broadly to, quote, de-risking. This trend emerged after the 2008 financial crisis, when new compliance rules imposed heavy new costs on banks, leading them to reduce exposure to countries where profitability was judged too small to be worth the risk. Many saw the $1.9 billion fine imposed on HSBC in 2012 for facilitating Mexican drug cartel money laundering as a cautionary tale. Yeah, it's jack shit. As a result, local banks in many smaller economies, including relatively advanced ones in the Caribbean, now pay more for their critical correspondent banking relationships in the United States, costs they pass on to their customers. In these ways, AML KYC models impose massive costs and foster inequity in the global economy. In this pandemic-interrupted year, those costs will be felt even more as remittances from rich countries to poorer ones are expected to drop by a record 19.7% to $445 billion according to the West Bank. Those flows have been seen as a major factor in poverty reduction, making AML and KYC compliance a direct barrier to prosperity. Regulators counter that financial crime is a big urgent problem. The United Nations Office on Drugs and Crime has estimated, for example, that between $800 billion and $2 trillion is laundered by criminals every year. But a trove of leaked FinCEN documents last month showed that large banks flagged trillions of dollars of suspicious transactions to authorities, but continued to do business with those customers. What's more, the high cost of compliance means those bigger banks, along with well-established money transmitters such as Western Union, enjoy a barrier to entry against digital startups, for whom upfront compliance costs can be virtually insurmountable. In sum, a AML-KYC dragnet with huge holes in it serves the interests of incumbents. It does little to stop sophisticated big criminals from moving money around, but prevents honest little guys from participating in transactions, all while protecting outdated financial dinosaurs from competition, which is the point, by the way. Enter Bitcoin. Bitcoin was in part inspired by a desire to challenge this model. By resolving the trust problem and creating the digital equivalent of cash, it enabled peer-to-peer online payments between strangers. No longer did you need to identify yourself. No longer did you need an intermediary. This terrified law enforcement, which relies on financial intermediaries to do its police work. So, amid ongoing accounts of criminals using Bitcoin, regulators went after the centralized custodial exchanges that people use to move crypto funds in and out of the fiat banking system, and developed rules that roped that industry into the surveillance system. The Multilateral Financial Action Task Force new travel rule has now internationalized this approach. Meanwhile, U.S. authorities have demonstrated that they will apply the BSA to crypto software providers, most notably with giant fine imposed this week on coin mixer Helix, whose privacy-protecting features were allegedly used by Alphabay, the defunct darknet market. That case underscores the far-reaching power this international system affords the U.S. government. The dollar's reserve status means foreign banks need to maintain correspondent banking relationships with U.S. banks, which then become gatekeepers of the world and effectively agents of Washington's interests. Now, crypto-inspired technology is providing more tools for people and even governments to avoid the U.S. gatekeepers. This week, Russia's central bank said it could use a digital ruble as a tool to avoid U.S. sanctions. Sustainable system? The system is broken. It has become a leviathan, too big, too comprehensive. Giant fines have skewed the risk versus payoffs for banks, which impose compliance on everyone regardless of size. This is despite AML guidelines typically allowing ID exemptions for transfers of up to $1,000, and in the U.S. up to $3,000. It's time to scale down, not up. Quote, "There is a principle in design that in order to optimize the system to maintain the most positive outcome, we have to sub-optimize the subsystems." Crypto compliance expert Juan Lanos said during this week's episode of the Money Reimagined podcast, quote, "That means we have to learn to live with a little money laundering. We might have to live with the risk that someone in Somalia might be a criminal trying to get through the cracks, and we don't really give a shit." A more open mind from regulators toward cryptographic technologies that help regulators manage system-wide risks without imposing strict identity requirements on everyone would also be welcome. Actually, no identity requirements would be welcome to me. Continuing. Research by the MIT IBM Watson AI Lab into how identity system risks within otherwise anonymous Bitcoin transaction flows offers one potential way forward. The test is whether policymakers can respond to the human cost of the existing approach. Quote, "Is this the system that really promotes prosperity in our world?" C Lab's General Counsel Brian L. What? Asked during the same podcast episode, quote, "I mean, yes, money laundering is very serious. Tax evasion is very serious, not really. But when we look at the remittance markets and the folks who are relying on transfers of $50 and $100, is this really what we want our system to be cracking down on? Is this the best use of our resources?" Battling global currencies. Bitcoin surged over $13,000 this week, and for once, the move was fueled not by the risk-on inflow that follows the rise in equity prices, but by some real news. PayPal's announcement that it would allow people to use cryptocurrencies inside its payment apps. Still, the bigger meta-narrative around digital currencies remains tied to the fate of the world's dominant fiat currencies. As Money Reimagined has explored previously, much will depend on the titanic monetary battle between U.S. and China, or between China and the U.S. So I decided to check in on two charts of each country's currency using the best non-correlated measures available. That meant avoiding the circular relationship in which the Chinese yuan is quoted in U.S. dollar terms, and vice versa, and instead using a standardized measure of each currency's performance against a trade-weighted basket of multiple currencies. What that gave me was a lesson in how powerful central banks are. The first chart, courtesy of Shuai Heo, CoinDesk's data visualizers, concerns the dollar. Federal Reserve Trade-Weighted Dollar Index. It looked like it went up and then has gone down. The image above is of the Federal Reserve's Trade-Weighted Dollar Index. It offers an unsurprising but telling story. After the initial COVID-19 panic of mid-March, when a global scramble for dollars sent the greenback soaring against all currencies, the Fed's unprecedented monetary expansion efforts sent it back down again. What's remarkable is, with the world still in a deeply troubled pandemic-choked state, the dollar has continued to fall. Does this reflect waning international confidence in the U.S., or merely a belief that the Fed will keep the money printer on overdrive but save the world in the process? Too soon to say. Now, the yuan. This one is based on the trade-weighted yuan index produced by China Foreign Exchange Trade System, CFETS, the Trading and Foreign Exchange Division of China's central bank. The index's spike in March might seem odd to the uninformed observer because that's when the world wanted dollars. Those panicked investors weren't scrambling to stockpile the illiquid currency of the country then worst affected by the pandemic. They only wanted greenbacks. But the explanation is quite simple. The People's Bank of China's interventionist management of its currency has for decades been dictated by a tightly managed, quote, dirty peg to the dollar. So, when the dollar spikes almost against everyone else, the yuan does as well. Why then did the yuan index rise after the midsummer, even as the dollar continued to fall? Because the PBOC deliberately intervened to boost the local currency versus the dollar. Sure enough, the USD/CNY exchange rate has dropped from 7.17 in late May to CNY 6.66 now. Is this to discourage capital outflows? Maybe it's to offset the need for softer domestic interest rates to boost local lending, which by extension equates with a Chinese bet on the domestic economy rather than on the nation's exporters, which favor a weaker currency. Or is China trying to take advantage of waning trust in American global leadership to assert the strength and appeal of the yuan and boost its own international standing, or all of the above? What's notable is that the yuan's rising value coincides with the rollout of China's digital yuan, which, although only in its experimental phase, is making waves worldwide. Stay tuned. Global Town Hall. Asia's Amazon, a prediction from a cryptocurrency entrepreneur, stood out this week. Not another Bitcoin $100,000 forecast, but this two-part one, which CoinFlip Chief Operating Officer Ben Weiss shared with Business Insider. The next biggest company in the world will be blockchain-powered, and it will be based in Asia. While there are strong arguments why both parties of that bet could prove wrong, the logic behind it is interesting to unpack. With the next Microsoft, Google, will the next Microsoft, Google, Amazon be built on blockchain technology? Of the problems with that is a popular public blockchain cannot be owned by a single company, and if one were to exist, it would defeat the core purpose of multi-party governance. But of course, applications that are built on top of a blockchain or which tap into users of one or more blockchains can be for profit, which is essentially the model behind successful crypto companies such as Coinbase. Notwithstanding those successes, and despite the billions that venture capitalists have invested in blockchain startups, it's fair to say the high-profit, quote, killer app hasn't yet been uncovered. And a good reason for that is the open-source public foundations of blockchain technology make it hard for entrepreneurs to develop businesses with defensible market positions. Yet, it took the internet's original entrepreneurs some time to figure out how to make money on the web. If we believe that, in one form or another, blockchain technology will provide the scaffolding for the financial system of the future, then it's reasonable to assume that someone will figure out how to make a lot of money with it. No, wrong. If so, where will this happen? Weiss argues the regulatory clarity in places like Singapore, as opposed to the ambiguity and sometimes hostility from regulators in the U.S., make for an environment that is much more conducive to future blockchain businesses. Currently, China is betting that by supporting a nationwide blockchain services network, which includes links to public blockchains, it will create the landscape for the next big company, perhaps more of an Alibaba than an Amazon. Here too, there are parallels with internet history. One reason why the internet took off in Silicon Valley is the U.S. government took proactive steps to open up innovation in the internet industry. First, there was the 1996 Telecommunications Act, which forced telecommunications providers to open up their networks to competitors, which meant startups could now use that infrastructure to offer broadband services upon which e-commerce could thrive. A similar effect was felt by the U.S. government's antitrust lawsuit against Microsoft. There seems to be little such vision employed in the U.S. right now to pave the way for financial transformation that cryptocurrencies and blockchain portend. It's too easy to say whether the big new Department of Justice lawsuit against Google this week, see relevant reads, signals a pro-innovation U.S. strategy to force a more decentralized internet or more of an ad hoc action. Either way, on balance, Asian governments like Singapore's or China's are proving to be far more assertive in laying out a path for a more decentralized future. This is not to say there won't be another Gates, Jobs, Bezos, and Zuckerberg emerging out of the U.S., but it would also be naive to assume the next big wave of business innovation will be in the U.S. and not some other region. I think it's more likely to happen here only because we do have some protections for entrepreneurs, and we do have plenty of incentives for them to be operating here. Anyway, continuing. Asia's euro. Still, with Asia, the uncertainty around the future of global finance and the rise of digital currency prototypes is reviving a 2-decade idea that the region should create a common currency akin to the euro. That's the case made by Japanese economists Teiji Inui and Watari Takahashi, Mamori Ishida in the wonky economist blog Vox EU. The trio argue that although Asian countries have learned how to better weather currency volatility than they did in the late 1990s, they remain vulnerable to capital flow shocks because of the asymmetric power of the dollar in the global financial system. So, they're calling for an Asian digital common currency as a multilateral synthetic currency compared to the euro. If that seems familiar, it should, because former Bank of England Governor Mark Carney, in a proactive speech last year, called for a similar solution to the problem of dollar dominance, but for the entire world. I'm not sure why, following the well-documented problems the Eurozone faced earlier this decade with the incompatibility between monetary union and political disunity, another region would want to replicate it. Perhaps regional governments would be motivated by geopolitical interests to keep China in check, as much as France supported the euro as a way to forestall German aggression. Either way, if it were to arise, it would put a new spin on the idea that the post-dollar age will be marked by one of competing digital currencies. The battle might not play out between nations, but between regions. Let's see. Relevant reads. 3 trends killing web privacy and decentralization. In a CoinDesk op-ed, Brave CEO and founder Brendan Eich and its senior privacy researcher Peter Snyder lay out barriers hindering efforts to protect privacy and foster the kind of open, decentralized economy that the internet was intended to be. They focus on areas of centralization and privacy-threatening surveillance that may not be on everyone's radars: content distribution models, centralized consent systems, and business models focused on building profiles of users. When people wonder why Bitcoin might be useful or valuable to people, I often ask them to put themselves in the shoes of people living in developing countries with abusive regimes for whom the movement of money through a politically controlled banking system is a challenge. Right now, one of the best examples of that is Nigeria, where protesters against police brutality are turning to Bitcoin for that reason. In this piece, CoinDesk's Sandali Handagama tells the human story of why Bitcoin. Let's see. Google is one of the most important antitrust cases of all time, with Matt Stoller. And I get the impression that these aren't part of this article. Yeah, okay. So anyway, we're not going to dive any more into that. That's just descriptors of other articles. We don't want to do that. But yeah, I think that the the biggest problem that these guys have, and this the author of this kind of shares the problem, is the lack of understanding of what creates the demand for a cryptocurrency or fiat currency or gold or whatever. It's the choice of people, individual people gathering collectively. That's what produces it. And so, like when we're talking about how to regulate it and whatnot, the market regulates itself. The market knows, you know how much risk tolerance you have. You know how much you are willing to dedicate to any particular venture. And it is not the place of the government, and it is not the place of any international organization to dictate that to you or for you. And cryptocurrencies, whether anybody likes it or not, are going to force people to be in a position to have to answer these questions for themselves. And ultimately, the decision won't be any more difficult for you than, do I prefer Ford or Ferrari? And that'll be the choice for you. And you will choose, not based on level of government compliance or any of that other bullshit, but you will choose based on how well that currency or system serves your interests. Do they preserve your privacy? Do they honor you as a person? Do they give you any shit when you want to move your money around? Do you have any difficulty moving your money around using a specific monetary unit? How much difficulty do you experience using that cryptocurrency or currency unit versus other currency units? And when you're evaluating things on these terms, stuff like maximalism and even national preference, those go away, because now it's how does this serve me? Does this serve me? Is this in my best interest? And this is where governments are going to have to find themselves, where they're going to be put in a position of exactly how much government is the market willing to tolerate. We've been forced to tolerate a lot more than we would be willing to tolerate if we had an actual choice in the matter. And I think that is a choice that people are going to be making. They're going to be looking at their bank account, and then they're going to be looking at their other accounts elsewhere. And where they're using accounts elsewhere and they're experiencing less friction, less questions, less scrutiny by the government or any other organization, that is where they are going to put the majority of their monetary value. That is simply nature. And getting good in discerning which projects are worthy of your investment is going to make the difference between whether or not you're successful. And there is no government out there. There is no government agency out there that can provide you with anything more than a guideline. All the safety nets that they imagine that are covering our best interests. They're in the end, they're going to understand that these create greater costs for us, not just in the experience that we have of taxation or any kind of friction like that, but in potential earning. Because if you make it too hard for us to do business in cryptocurrencies in one jurisdiction, the fucking business is going to go elsewhere, where they're not as difficult, where they're more freely flowing. And you would rather the economic activity happen with us and between me and you, right? Well, I have a choice in the matter now. I can say no to you. So if you want me to say yes to you, you have to provide me of something of value. And no, you're not gonna wave the gun in my hand, in my face as much. Because what that's going to do is it's going to cause me to look for a vendor who won't wave their gun in my face at all unless I like actually rip them off or something like that. And I will disenfranchise you. And that's all there is to it. That power is in my hands now. That power is in the hands of 9 billion people, whether or not they actually know they have it. And when they get around to expressing it on that level, and they will, regardless of what you try to do, get us circulating CBDCs or fucking government issued tokens, it doesn't matter. One way or another, you are still going to come to this. Bitcoin happened for a reason, and it will continue to happen until the efficiencies of a fully open, fully decentralized cryptocurrency are in the hands of those 9 billion fucking people. We will have it. It's possible, and so we will have it. Anyway, let's go ahead and throw back down with some music. But where to go? Man, that's a good rant. I feel the need for some Sepultura, because that song that got me thinking of a very specific song. And so here it is, Arise by Sepultura, here on Coin Metal. And that was Soundgarden with Rusty Cage. And it is with that I'd like to close out this episode. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Monday at 8 p.m. Pacific Standard Time. And so until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. And so as far as our last dance is concerned, I'm going to have to pick something kind of short and kind of sweet. I'm looking for it now. Let's see here. Where is it? I think, yeah, we can fit this one in. Megadeth, Kick the Chair, Last Dance, here on Coin Metal. Thank you again for listening, and y'all have an excellent weekend. Good night.